The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. I'm your host, Darrell Martin, here on TFNN. Don't forget, you can listen to us anywhere, tfnn.mobi. On your mobile phone, 9 hours of live trader audio commentary every day. Well, let's check it out. Let's see where we're at. We got the S&P is down 2 points right now. We got the NASDAQ down 16. We have the Russell's down almost 7 points. We got the Dow, though, pushing some strength. Is actually positive territory after that monster run yesterday with the Fed news announcements, up 7 points right now. But, ran up, obviously, with that big move on tapering. But tapering that wasn't that big and that said, hey, you know what? This doesn't mean that we're going to back off accommodating. And, we're going to back $10 billion off. $5 billion off this part, $5 billion off that part. Sounds so nice. But we're not going to back off of everything, so don't worry. And the market did not worry. Probably was just glad to see that it was $10 billion. At the same time, there's a reality. They may be backing off, but what are they not doing? We'll go over here. Got temporary. Well, they're backing off, but yet somehow or another, they accomplished to do an extra $19 billion in their repo market today on their temporary market operations, which they don't seem to talk about as much. You don't really hear that happening, too much in the market. But you got the temporaries happening, and they're just literally pumping these things like crazy. $15 billion today. We got $11 billion. Yesterday we have $14 billion. We have $6 billion. We have $17 billion. We have $26 billion. If we go down and we add these up, they're way surpassing that $85 billion. So they're trying to make it sound like they're backing off, but really they've been ramping it up the entire time behind the scenes. So, not anything to worry about because they're not tapering. They're just tapering this program, but they're ramping up the other one. So it's absolutely amazing. So, some nice deep pockets, right? Just to be able to print it. Let's go ahead and print $15 billion today. Does that sound good? I mean, where are the numbers coming from? Like, wouldn't you love to see that formula? Nobody else wants to buy the junk. So $15 billion right there. People are like, let's go ahead and, I don't even know how you fluctuate that from 4 to 17 billion, 6 to 17 billion, 14 billion. I mean, it's like a random number every day. But anyways, that is it. That's the reality of the market. So, you just got to join along. And let's check out where we're at in the market. And what we can do, we might even see if we can take advantage of anything along the way. But just to catch you up across the board, we got the indices covered. Let's maybe those other indices, they might catch up, they might pull up. I don't know, 15 billion, will that be enough to push it all the way to the top? And what do we got on permanent today? Let me check that out too real quick. So again, this is newyorkfed.org. You can check this anytime you want to, right under market, open market operations. And you can see what the operations are every day. Looks like today for 12/19, they started at 10:15. They closed it out at 11 o'clock. And, they submitted to 5. They only got 1.5 pulled off. So they accepted a $1.5 billion in their program today. That's not a surprise, by the way. You should be able to know exactly what amount they're going to do. They'll say not only the past 2 weeks, but you can actually see the schedule. So if you go on here, I don't know, they keep moving some of these links around. But they'll actually show you, if I go to, maybe it's to open market operations. You can go on here and they have links. They'll show you the schedule for how much they're going to do every single day. So you know what they're going to do on open market, permanent, but temporary, always a fun surprise. So, all right, back on the markets. We got the gold market right now is down 40 points on the day. We got silver is down 4%, over 4% today. Copper is down, it's trying to get to 1%. And right now we got oil running on up, $1.32. So, which is, I mean, pretty much every penny, it's right around $100. So, it's basically a percent. So if you got 1.3, then guess what? It's 1.33% move based on current pricing. We got natural gas is up almost 4%. So natural gas being just a crazy volatile instrument. Talk about one of the ones that I don't trade. That one right there. And you can trade it on Nadex, which is cool. But even with that, I mean, it's just the volatility is consistent. And traders will come in and they'll go, what's the most volatile market? Because that's what I want to do. I want to straddle or strangle that one or, whatever. And the problem is, if it's always volatile, then that is built into the pricing. It's the surprise volatility that pays off, not the consistent volatility. So it doesn't necessarily mean it's going to help you because it's so expensive. We got soybeans down a mere $4 on the day. We got corn up about $4 on the day. Euro dollar is currently down just 20. Pound dollar is down 23. Aussie dollar is flat on the day compared to settlement. We got euro yen down 63 pips. U.S. yen is down 12 with pound yen down 20. Dollar CAD down 21 and dollar franc is up 28 pips on the day. Okay, so that catches us up, and on where everything's at, let's also take our look over at the news and see what did we have on the plan, what do we have on the roster, what numbers came out, and as we know, FOMC yesterday, we can pull that chart up. Give me a second. With that charts, pick your chart. Everything went a little bit haywire, right? I think that's yeah. So went absolutely nuts, and you even saw like gaps happening in the indices, and I mean stops being ran, and you saw things flying up and down every which way. But let's hop over to we'll just hop over to the S&Ps. We'll back on down to 5 minutes, and I got that nice spike to make sure that anybody who thought they might want to go short, yeah, good luck, because then it ran right back up. It took off. I know some people who did straddles. And did strangles, and they did great. But actually, I was testing Russell. I was looking at implied volatility built into Nadex options versus my implied volatility model on deviations with trader with Steven yesterday, and we were looking at it, and Nadex had like 10 points built in, and we had 14 built in for a single deviation. And so I'll show you this. Check this out. We go over here. We basically got settlement right about this price, right around 11.15. And so they had built it in that it would go to 11.25. So I'd built in that it'd go to 11.29. So it looks like we were all wrong, but I was more right. Anyways, but that's good because by checking that, and that's something I'm going to start looking at, compared their volatility to our volatility, they underpriced their options. And so you could have literally hopped in and done a straddle, and what was it at? Actually, I think we could have got in on the straddles. It was, since it was 10 points, it was 5 points above and below. So it was like 11.20 and 11.10. Yeah. So you could have got in on a straddle last night on Nadex. Not last night, but night before last. Or would that be? Yeah, night before last. At 6 o'clock. Okay? And, I mean, it would have, I'm not saying it would be cheap. We put up $50 on each side. You're talking $100. Cost, but I mean, when they expired over here at 4:15 right here at 11:32, put $100 in. Oh, you got that 50 back. Okay, you lost the next 5 points because you assume this side loses unless you're just the master trader and you took off on both sides. But probably didn't do that. You're waiting. Flies down, flies up, goes up to 11.25. Okay, now you're at break even on the trade. Ends up at 11.32, and you basically netted out a $70, so profit, which would be equal to $700 if you did 10 contracts. So not too shabby. If you did one, $70. So not quite a 1-to-1 on a $100 risk, but I'm talking about a simple trade. I mean, that's literally if you just put the thing on at 6 o'clock and never look back. Okay, so you gotta love trading on straddles and strangles, not worried about them, and it's just that advantage, that 1 day pricing, where you're not paying for all that theta like to the end of the week or the end of the month or whatever. Anyway, some nice moves, and Russell's been heading down, came down, hit its half deviation mark, has been bouncing off of that. We'll see if it's able to do a rally and end on a positive note or not at the end of the day. But that's where we got the Russell at. Let's go ahead and check out our news trades beyond that. We talked about some of the stats yesterday on the FOMC, so let's see how those added up. Okay. Let me pull them up over here. We did a couple of them. The Aussie dollar one that I was a little bit cautious on at the beginning. I'm like, hey, I'm demoing this. That one did not work. The euro dollar one, the pound dollar one did work. As you know, yesterday, if you listened to the show, I'm like, pound dollar is my favored one right here for hopping in and pulling off a butterfly going into the news. And the pound dollar one, it was just pristinely perfect. So it's 20 pips wide, had the widest one because there was already so much volatility. But what about after? How to do afterwards? Okay? Well, afterwards, it really, really did move for us. And let's see here. If we can go in right before news. Over here, we got 36.97. We got up to 36.48. So we got about 82 pips to the upside, right? Okay, or I guess if we want to get like real, right at 64. It's so close, just to make it easy. A little over 80 pips. What was our expectation? So remember yesterday I said, this is how far I expect the pound dollar to move. And the pound dollar movement expectation was actually 70 pips. So we got more than the expectation to the upside. So that one worked out beautifully to the downside. Let's see here, if we put this like right around, 64 or whatever, then go down here to 63.43. We got about 57 pips to the downside before that massive reversal. Cool thing is we didn't care which way. We just cared that it moved. And it definitely did move. And then, now, remember, one of the things I also looked at with you, which was pretty cool, is we went in and we talked about doing a iron condor. Because it was so expensive to pull off on the spreads. I was like, hey, you can take out the strangles. Strangles may have worked out great for you. But what I wanted to go into this with you was to look at, what about this iron condor concept that we talked about where we went in and we did a spread on it. We bought one side, sold the other side. Is that something that would have worked out for you? And I got to start the trade. Obviously, I couldn't finish the trade with you simply because, obviously, time ran out. So let's look at this. Let me open up. We got the buy. We bought it for $35. Okay, so let's see if it'll give me the rectangle down here. So we bought a 64.40. Oh, wait a minute. Hold on. Got one other one. I want to get the right one. That was the butterfly that we did that worked out well. And I know I have it in here. And I just wanted to go through like the settlement results with you. So I'll have that down in the commercial break. I'll pull it up. There it is. I got it all up now. And settlements and all that. So we'll put the pieces together as soon as we get back.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzamento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Trading Hour. So, again, just going through each one of these little steps. I'm trying to do the math for you right there during the break. And trade came out pretty cool. Let's see here. So let's put all the pieces together. Let's see how this really works out and what happened. I'm trying to take pictures of all the screenshots for you just to make it as simple as I can. And let's go over here and let's see what happened. Okay? So we went in, and this was like right near the end of the show. We hopped in. We sold the 1.6390 to 1.6540. Okay? Strike. That expired at 3 o'clock. And then we went in and we sold it at 16425. Now, this was an iron condor. It was reverse. Okay? The cost on the trade, the risk was $115. The prop potential was 35. So, basically, what that, the reason for that is 150 pip wide spread. So, it's always going to equal 150. Up here, we on this side, we bought the 1.6240. And we sold the 1.6390. We bought the 1.64 to 1.6390 for the price of 1.6351. So, I went ahead and put the math in here. That means our risk on that side was $111 with a $39 profit potential. Okay? For, maximum profit, we needed it to stay in between these two ranges. So if it would have stayed in between 1.6425 at 6351, we'd get max profit. So 74 pips basically is what that would have came out to. Which if you add the amount we receive, if it was like right in that center, that's where that 74 pips comes. And that's like if it's right in the center, our payout would have been 74 pips. Now remember, every pip, every tick on Nadex, always worth $1. Okay? So 111 ticks is $111, and we did 10 contracts, okay, on each side. So, we had a, risk. Just make that easy, make that a negative number there, right there. So that's our total risk, total max reward potential on the trade. So now we can still make money on both sides. This isn't like a binary. This is depending upon where it expires in the range. So let's look at where did it actually expire in the range. Okay, it expired at 1.6430. So if it expired at 1.6430, then we still get some of our money back, but not all of it back. But we make money on, we can make money on one side or the other. So let's see here. On this one. I think we added some in too. Okay. So now that we have all those pieces in, now I want to pull up the profit payouts. And I think we got them in. So we got 20 on that side, 20 on that side on the payout, 20 on that side. Okay, so we actually ended up doing 20. I added in twice. So that's what I want to make sure, because I was like, wait a minute, 10 or 20? So now we know that's what our payout is. Okay, it's based on 20 contracts on each side. So let's go in and let's just edit this number right here. Okay? And we'll edit this one right here. And we'll also, of course, got to give ourselves credit for the payout potential. That formula, just simple little math here. And so how much can I make? Well, I had $39 times 20. There we go. I like the other one better, though, right? And then we had 35 times 20 for our potential payout on that trade. So on each side, because we ended up started off with 10 and then we added in more. All right. So with that, what happened? Did we make anything? Did we lose anything? This one expired a little bit above this. How did it all work out? Okay. Well, on the 6240, 6390, on this one right here, we put up, okay, the one that we bought, we put up $2,220. We actually got a payout of $3,000 on the trade. Okay? So basically we got $3,000 back. Now, let's minus the 2220 there, and then we actually get our net profit. Come back to the other side. See how it all panned out. Did we make money on the trade or not? And what would have been the sort of realistic worst case scenarios we were looking for? Stay right there. We'll be right back after this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
All right, so I got a lot of information up here on the screen. And going through basically my iron condor strategy on spreads when the spreads are overpriced. And you're like, that's too expensive. I'm not doing that. I'm not putting up that much money because why would you? All right, remember, what did we say the expected range was on the pound dollar? Well, we said the expected range on the pound dollar off the FMC was approximately, okay, going to be around 70 pips. So if it costs me, 39 plus 35, I'm looking at, 74 pips of cost, which means at best I would break even if it moved 74 pips exactly. So there's really no good way to profit on that trade, okay, by going in and straddling that trade, which would mean buying the spread above it and selling the spread below it. And let me put this on a chart for you to help it make a little more sense. Okay, so if we're going in and 1.6240 to 1.6390, so basically right here up to, we'll do the top one first, and let me change it over. We got a rectangle, okay. So 1.6240 right there, all the way up to 1.6540. So way up here, this is the box. Okay, so when you hear me saying box spreads, you're wondering what that is. then this is what it is, 6540. This is the ceiling, this is the floor, this is when I decide to get in, this is when it expires. So if we also want to go in, I'll activate that, I'll bring it down. It's a very short-term spread, like we're looking at 3 o'clock because that's when the spreads expire. Okay? And we got into it a little sooner. So we got in there just literally a couple minutes before. There we go, right there. So we hopped in the trade. Now also, let's duplicate that, then move one. We had one below it. Okay? So now that we got that set, now we can zoom in a little bit. Maybe put it on the auto scale, back out. And what I was saying on the expected range is we basically only expected it to go up or down like 70 pips. So we only expected it to go to maybe about 70, or, you know, down here to, what would that be, 30? 63.30? That was really our expected range for the market to move. And if the spread cost me $35 to buy, you know, the top side, and it cost me, you know, say 35 or so to sell the bottom side, and I plan on losing one side or the other, then after it moves 35 pips, I'm break even on this one, and then I got to make the $35 on the one that's going to lose here, so moves another 35 pips. Once I've got my really max expected range, then guess what? Like, I'm break even. So I just looking at the model, I'm like, there's really no way to make any money on this trade unless it just goes like 150 pips, okay? Because that's really what you need. You need like a 150 pip move to be profitable. And I'm like, wait a minute. Wow, well, if that's a bad idea, maybe the reverse is a good idea, okay? So let's look at what does that mean, because that's what we did. We did the reverse on the show yesterday. We went in right here, and we bought, okay, the 62.40 to 63.90 for 63.51. That gave us a risk of 111 pips, because if I buy, my risk is in between where I buy and the floor. Okay, so 63.51 down to 62.40, so I can lose 111 pips. Okay, my max profit is in between where I buy up to the ceiling. Now, it can go all the way above the ceiling, and I still get my max profit. It doesn't have to stay inside of it, okay? But my risk will never become larger no matter how far down it goes. My profit will not become larger no matter how high it goes, okay? Not really a big deal because, I mean, it's 150 pips wide. Well, I think we're okay. So we go in here, we look at that, and I'm like, all right, so $780 is the most amount of money I can make on the trade, or 39 pips, actually, technically. Now, we did 20 contracts, so that's why we got to 780. Therefore, my risk on the bot side was $2,220. Okay? My profit potential was 780, which seems just completely crazy when you first look at it. Okay? But stay with me, because this makes a lot of sense. And if you get it, it'll add a whole another level to your ability to capture premium. I mean, this is iron condors in an hour or two. Okay? But better. All right, so let's keep going. Now, on the other side, I sold. I sold the 63.90, and I sold the 63.90 to 65.40. Okay, usually you'd think about buying that one. Okay, that would be your standard, straddle. And but since I sold it, then my risk is that it's between where I sold and the ceiling. Can't lose any more above the ceiling no matter how high it goes. It's capped off. So I have 115 pip risk, okay, from 64.25 up to 65.40. And then my profit potential is from 64.25 down to 63.90. Okay? So with that trade, with understanding that concept right there, that means I could make up to 115, or I could lose up to 115 pips. I could make up to 35 pips. So now that we have that, that means that since I did 20 contracts, I'm risking $2,300 on the sold side, I'm risking $700 on the bought side. Seems a little nuts at first, okay? So, but now let's look at a few different scenarios of why this is maybe not as bad as it sounds. Well, one is it can't expire up and down, okay? Like, the price at 3 o'clock is going to be at a price. So either the bought one's going to make some money or the sold one's going to make money, but they both can't lose. Okay? Because, I mean, it's going to go up or down. Or it could stay flat, which would be awesome. The more flat it is, the better off we are. We'd actually make max profit. So what is the maximum amount of money that we could make on the trade? Well, the max we could make would be if it stayed right at, let's say if it expired, which we don't expect. But let's just say it expired right at, okay, the floor ceiling, that's 63.90, okay? And just to give you back that picture real quick, right here. It expired right here, right where it was, right in the center, okay? And it did come back to that level quite a bit. But let's just say if it expired right there, then our maximum profit potential is $1,480. Okay, you go, well, that's still not the greatest risk reward, but it's not as bad as 788 at 2220. Okay, so this is max profit right here. Okay, on both sides combined. So now that we got max profit of $1,480, then what does that mean? What about break even? Okay, so it's like, all right, well, now I know what the most I could lose is. And by the way, well, actually, we haven't even talked about that. So, because the most you could lose is not 2,220. The most you could lose is not 2,300. That's the most you could lose on one side. If you took max loss on one side, think about this. If you went in here and you, see if it'll let me do this. Let's say you bought here, okay? And then it went all the way up to here. Remember, this is your box right here. Then you made max profit on this side. So let's say it went all the way up like it did. It blew through this side of the box on here. Not necessarily bad, though. You'll see. So, because remember, the box is actually a lot bigger. But flies on up here. This is just our range. Flies up here. And we'll just say this thing actually did. Let's say it went up to like, I mean, it shocked everybody, and it went to 6,500. Okay? Way beyond the expectation. We'll even, we'll make it higher. We'll make it 66. Okay, so let's just say, let's just go for like worst case, oh my gosh, I can't believe that happened scenario. Or let's say, you sold right here. We'll get rid of that one. And let's say it flew down this box right here. Okay, remember you bought this one, right? So, and you sold this one. So let's say you took max loss on this one you bought because it went down to like 6,200. Massive move. Right, obviously not expected at all. But let's just say that massive, insane move happened because you always want to know, what's my worst case scenario? Well, if it flies all the way above here, the one you bought here is going to have max profit. The sold one is going to have max loss. If it flies all the way down, the one that you sold, okay, below that, like, so if I went in and I sold this one, the one I sold is going to have max profit. The one I lost, let's say it flies all the way down here, the one I bought is going to have max loss. All right, so that's my worst case scenario. So then what happens on that? Well, what that would mean is my max loss being 2220 on one side and 700 on the other. Let's add those together. And what do we get? 1520. So the worst thing that could happen is if it flies down and I take max loss on my bought side, which would mean I get max profit on my sold side, the worst I could lose would be 1520. Or, this number can go a lot further down. We could divide that number by 20. So if you want to know, like, oh, that's too big for me, or whatever, depending on your account size, $76. Okay? So not a bad scenario. I'm looking at doing 20 contracts here. If we go down the other side and we go, okay, well, what would happen on this one? What if it flew all the way up and I took max loss on my sold contract? Well, that would mean I have to have max profit on my bought one because it's above the ceiling of the bought one and went all the way above the ceiling of the sold one. Okay, that's worst case scenario, 1520. So now, this is pretty sweet. We're looking at pretty much a 1-to-1. $40, okay? a 1-to-1 scenario here. Iron Condor, 2 hours to go. Look at 1-to-1 risk-reward ratio. I like those odds. I like 1-to-1 risk-reward. Okay? And so, well, okay, so what happens in between? And we'll talk about what actually happened here in just a second. But what happens in between right here on this show? How's it going to work out? Well, so what I did is I said, okay, let's go ahead and put the bought floor right here. This is the one I bought. Remember, max loss is below it, right? And I got this old ceiling right up here. So like max loss would be, of course, above it. And then this was the strike, that brought them together, that made them, iron, condor, butterfly, whatever you want to call it. Okay? So right here, we got this map. We got the center of the strike. Now I sold this one. So right there. And I bought this one. There we go. So right there for my ceiling. And I sold it at 64.25. And I bought this one, okay, at 63.51. So doing that means that I will make 39 pips, okay, if it expires above 63.90. Because that's my max profit. If it's above 63.90, that's the most I can make. It's that difference between where I bought and where the ceiling is. Okay? And so let's see here. Make sure all that lines up for you. Yeah, 63.90, and then we bought at 63.51. Okay. So approximately that difference, if we did that right, 63.51 minus 0.035. Okay. So if we go in and we did that, I want to double check math. I'm always double checking the math. All right, yeah, okay. So yeah, we can make 39 pips. All right. So I have a 39 pip max profit if it expires above 63.90, at or above it. Now I still make money in between. Okay, so I make actually in between these ranges, like anywhere in between here, I'm going to make up to 14.80. But where do I actually start losing money? Okay? Where do I get to that break-even point at expiration? Well, since I know I can make 39 pips, I can lose 39 on the sold side. So, it's break-even after the price where I sold at, plus the 39 pip max profit I'm making on the one that I bought. So if I bought it and it can make 39 pips, and I sold it at 64.25, then I just add 39 pips to 64.25, and so my high side, where I'm neutral, break even, whatever, 64.64. You can go up to 64.64 before I break even. On the downside, I just subtract the 35 pips max profit from where I bought at 63.51. That brings me down to 63.16. So stay tuned. We'll talk about what that range means to you, and we'll talk about what the net result was. This is definitely a trade you're going to want to start checking out.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, here we go. We're going to wrap this one up. So, hopefully you're paying attention to this one. It's a pretty sweet strategy. Maybe we'll have to do a webinar on it. But, okay, so we got it up to 64. We got it down to 63.16. The difference there is 148 pips, meaning we have a 148 pip edge, meaning if it's anywhere in between these 148 pips, when it expires, okay, up to down there, we will be break even or profitable. The further it is to the center, the more money we'll make, but we don't even start losing a pip until it expires outside of that range. Okay? So, if it expired at 64.65, we'd lose a pip. So we'd lose like $20 on, 20 contracts. All right? So it's 1 pip above it that we start actually losing money. And 1 pip at a time. And it's not all or nothing. It's not like binaries, just spreads. So we got that right there. Got a 148 pip range. We have an expected range of 70 pips up or 70 pips down. Okay? So, really, it's actually an expected range of 70 pips high to low. But, so with that, how does that turn out? What happens? Well, let's see. Well, where did it expire? Well, it actually expired pretty high. It expired up at 64.30. Okay, that was the expiration value on the contract. So if we go over, if I can pull that up real quick, show this to you. All right, so yeah, there we go. So expiration value, 64.30, just so you can see what I'm talking about. So that's where the pound dollar was right there at, 3 o'clock. If we get in and we narrow it down, we look at 1 minute. We look at yesterday. Go right in here, 3 o'clock. So, yeah, right there on 64.30 was our settlement value, okay? So 64.30 was the settlement value. What does that mean to our overall net P&L? Well, since it expired above, remember, it's at 64.30, right there. So that price is greater. Okay, that price is greater than the price that actually was ceiling. So let's go over here. We'll just grab a line real quick. Remember, here's our ceiling, 63.90, expired at 64.30. So 64.30 being greater than 63.90 means we get the max profit. So, well, how do I know we got the max profit? Well, remember, I put up 22.20 as a debit from my account, and my payout was $3,000. So they said settlement payout $3,000. What, did I make $3,000? No. That'd be nice. I made $780, right? Because 22.20 was the amount put up, $780 was the amount made, so the total amount paid out was $3,000. So made $780, made max profit on that side. Well, what about the other side? Well, it expired at 64.30, right? So let's look at that. Well, what is that? What does that mean? Well, what do we sell this one at? 64.25. So it expired 5 ticks higher than where we sold. Okay, so we lost 5 ticks, 20 contracts. Okay, so the net result there was we lost just $100. We put up 2,300. We got 2,200 back. So the difference there, we lost $100 on the short side. We netted a $680 profit. Now you may go, wait a minute, but when your risk $1,500 on the trade, and you only made $680. Well, remember, my risk is only $1,500 if it moves like an insanely massive amount. Basically, it moves 150 pips up or 150 pips down, which was way outside the standard range. And so any amount in between that, I'm making or losing, less than or more than that. So we can have that max profit right here, 1480. Then it goes down as it goes up or goes down as it goes down. But having a 150 pip wide range on a 70 pip expected move, we knock out a 680 profit, and a lot cleaner and easier than doing binary too. All right. Anyways, hope y'all learned something today, and I will see you tomorrow next time on the Diagnostic Trading Hour.
I believe that we're all here to contribute something unique, and that deep within us lies a special gift, a special talent, our own bit of genius, just waiting to be tapped into. When it comes to trading and investing, I can help you tap into yours. Hi, I'm Steve Rhodes with TFNN, and on Thursday, December 19th, I'm hosting a 1-hour workshop where I'll share with you my most incredible discovery yet, the Rhodes Momentum Indicator. I developed this tool with one outcome in mind, to do what nobody else considered possible, to put the power of the most advanced indicator, scanner, and trading strategy in the hands of people just like you and me. I can promise you this, you'll never look at a chart the same way again. This event is available to all subscribers to my newsletter service, Mastering Probability, which for the holidays is available free for the next 30 days. No charge whatsoever to new subscribers and no obligation on your part. Please join me by going to the homepage at TFNN.com to sign up for this once-in-a-lifetime opportunity.